Happy noon, Akash. Sorry, sir. Good afternoon. Completed a presentation of the illustration number 12. Not done due to Bonala. Okay. Okay, Akash, I will show presentation. Voice and video quality are clear. Okay, then. First thing, we understand the concept of the arbitrage absent. Okay. So in a simple manner, we have a two company investments. If I shift from one company to another company, vice versa, in the process of shifting, if I gain a profit, that profit is known as arbitrage profit. In simple terms, are you clear? Now, when it comes to the detailing, wait a minute. Call me in chess, sir. So, okay, when it comes to the detailing, so there are two types of firms. When it comes to the two types of firm, one is levered firm, another one is unlevered firm. So there is a noun assumptions is there. If you shift from levered to unlevered, you have to follow one assumption. If you shift from unlevered to levered, you have to follow another assumption. Okay. When you are following an assumption, first, when you are shifting from unlevered firm to levered, there is an assumption you have to invest that entire amount in your hands on equity plus debt of the levered firm. Guys, clear? Then only you can get an arbitrage profit. Assumption number 2, it following at the time of shifting from levered firm to unlevered firm. The assumption saying that, so you already bear a risk in levered firm. That's why when you are leaving from that company, you are capable for bearing a risk in outside also. That's why sold your equity share as well, take a loan from the outside because of your risk capabilities. So then you will get more investment. If you put that more investment in unlevered firm, you will get more returns. If you follow this assumption only, you get a profit. Okay, then when it come to the presentation, what's the illustration number as per our material? Illustration number 12, 15. Not there, okay, we will adjust. Problem number 15. So they asked two questions, right? What's the case here? Estimation of arbitrage profit if investor shifting from, don't use the word unlevered, use the word company names. Are you clear? In case one, where is the then there is no clarity about the shifting, but they're saying a indirect word. I have a 10% stake in drill. It means common sense, they're shifting from drill to sill. Shifting from drill company to sill company. Now first you have to calculate profits on existing company name, RIL, profits on RIL, that equivalent to, I think it is unlevered from, right? That entire EBIT will share to whom? Equity shareholder. How much stake I have? 10%. 10%. Now, what is the equity earnings? Equity earnings into stake. Now 100 lakhs into 10% of stake. How much returns I will enjoy in that company of real? 10 lakhs. Next. Amount in the hands of investor after selling his stake. In real. Amount equals to, so where we sold entire firm value or only market value of equity or market value of equity share capital? Where we sold. For how much you will receive means, if you have sold your entire market value as a stake, or market value of equity as a stake, or market value of a debt is a stake, or only market value of equity share capital is a stake, which one is your stake? My stake is equity. My stake is what, sir? Equity. They specified entire clearly 10% stake in equity, but there is a common sense. Equity share capital is different, equity is different. So when I invest amount on the company, that is called equity share capital. When I sell the share, I will receive two things, capital as well as profit share. Now equity share capital plus reserves and surplus is known as equity. I am selling here. That's why I need to calculate on equity value, not on equity share capital. Guys, clear? Now, equity value into stake. Now, what is the market value of equity of real? 2000 lakhs into stake 10%. How much? 200 lakhs. If I sell my stake in real company, I will receive amount cash 200 lakhs. Guys, clear? Now, what's the point 3? I need to put this 200 lakhs in where I went to. I'm going to where? SIL. Percentage of stake if investor invest 200 lakhs in SIL. Now percentage of stake equals to investment amount divided by, here you have to take an assumption where you are investing only an equity of SIL or both equity plus debt on SIL. Equity plus debt on SIL. Now what is the equity plus debt value? Can I use the word market value of SIL? Market value of SIL. Now amount of investment 200 lakhs divided by market value of SIL 1000. Go and check here. That 1000 is known as market value of equity. The 1000 is known as market value of equity. What is the meaning for market value of firm? If it is a levered firm, market value of equity plus market value of a debt. It means it is not a right answer. Sum of these two is known as a right answer. If you take directly 1000, your answer is wrong. Guys, clear? They just play with the names, not a concept. Concept is easy, just names are different here. Now when it comes to market value of SIL equals to equity plus debt, that equivalent to 1000 plus 400. 1400 lakhs is a market value. How much stake you will receive if you invest in SIL? Calculate and tell me. (14.3%) approximately. 14.29 something. I'm going with the 14.3%. 14.3% of ownership I will receive. Now the point is, on that 14.3% receiving on only on equity or debt, or both. Both. That is an assumption. So if you put this 200 lakhs and 1400 lakhs means here 1400 lakhs, 1000 is equity plus 400 is debt. Are you clear? In our presentation of our material, they showed proportion also. Out of 200 lakhs, how much I invested in equity, how much I invested in debt. That is not requirement. Are you clear? But that's a step you follow, no issue. Now for example, proportionment of investment. Now amount on equity. So that equivalent to 1000 into 14.3%. 143 lakhs. Amount on debt. 400 lakhs into 14.3%. Now how much? (400 into 14.3%) 50. So go with the round off. Why? Because 143 is a round off value. Now what is the total amount? Completed. So I invested 143 lakhs in equity, 57 lakhs in debt. That is called proportionment. Guys, clear? Now okay. I understand the stake, how much I receive. Can I calculate the profit? Return on SIL. Now that equals to, we have two returns in SIL. 100 lakhs is a equity, 100 lakhs is a company earnings. Out of 100, 80 lakhs is a equity earnings and 20 lakhs is a debt holder earnings. Guys, clear? Now where you invested? Only equity or debt plus equity? Where you invested? If you're shifting from unlevered to levered, you have to invest on both equity as well as debt. As means I have a right on this 20 lakhs as well as I have a right on this 80 lakhs. Guys, clear? In simple terms, I have a right on where? Total company earnings. Are you clear? How much percentage of right I have means 14.3% of right I have. You can go and check. This 14.3 calculated on only 1000 rupees or 1400. 1400 means what? Equity plus debt. Are you clear, sir? Now see. First, I will receive interest plus equity earnings. When it comes to interest, 14.3% on 20 lakhs plus 14.3% on equity 80 lakhs. EBIT is 100 lakhs of the company, guys. First settlement to whom? Debenture holder, 20 lakhs I settled. There is a no tax in the question. That's why the entire 80 lakhs is a whom earnings. Equity shareholder earnings I will share. Now what is the total earning share? 14.3% on 20 lakhs. 2.86 lakhs. How much share you will receive on equity? 11.44 lakhs. Now please tell me the total earnings I will enjoy. 143 lakhs. 100 into 143%. Oh, 14.3%. Guys, clear? Now it's time to calculate arbitrage gain. That equals to a return on existing company minus a return on new company. Now if you solve like this, you will get a negative answer. That's why convert this new and existing reverse. New company and existing company. Profit always shows positive only, na? Now what is the new company earnings? 14.3 lakhs minus how much you were enjoying previous company? 10 lakhs. How much you will enjoying extra? 14.3 lakhs. 4.3 lakhs. If you shift from RIL to SIL, you will get a benefit of rupees how much? 4.3 lakhs. That is known as arbitrage profit. Any doubts on this? Guys, clear? So we followed assumption. If you not follow the assumption, so entire subject will be changed. So if you not follow the assumption, what change means? You need to put that 200 lakhs only on 1000 lakhs of equity, not on 1400 lakhs. As per assumption only, we are putting on equity plus debt. Guys, clear? Done. Case 1 completed. What about the case 2? Estimation of arbitrage gain if investor shifting from where to where, sir? SIL to RIL? SIL to RIL. The subject saying that SIL is a levered firm, RIL is a unlevered firm. Here also you have to take another assumption. What is another assumption? You can take a loan from outside. That is the assumption. Okay, done. What's the step 1? First, calculate existing earnings. Return on SIL. Return on SIL. So my question, where you will receive? Only on equity share, or you will receive equity interest also? Interest also. Just understand. 10% stake in company of SIL. Stake means what? Only ownership, na? If you have only ownership, how you expect interest? If you are debenture holder, then only you can expect what? Interest. Guys, hope you understand. Sir, then why you calculated above means it is an assumption. I put an investment in where and where? Equity plus debt. That's why I am a equity shareholder for 14.3% as well as a debenture holder for 14.3%. Guys, clear? Now, return on SIL means you will enjoy only equity earnings, not equity plus debt. Are you guys clear? Why? Because I have only stake in ownership. Now, return on SIL equals to equity earnings into stake. Now, what's the equity earnings? 100 lakhs or 80 lakhs? 100 or 80? Company earns EBIT 100 lakhs. Out of interest 20 lakhs is there. What is how you get equity earnings? Minus interest, EBT, minus tax, you will get equity earnings. There is a no tax. That's why EBT is nothing but equity earnings. Now 80 lakhs is the equity earnings. How much stake I have? 10%. Previously I enjoying only how much earnings? 8 lakhs of earnings as a 10% stakeholder in SIL. Okay. Now what's the second step? What is the second step? Amount in hands of investor after selling his stake. Amount in hands of investor after selling his stake in SIL. Now amount equals to equity into stake. Equity into stake. Now how much is the equity? How much is the equity? 1000, huh? No. Go and check the case B. Go and check the case B. Show how an investor holding 10% stake in the equity of SIL can generate the arbitrage profit, assuming that the market value of SIL is market value of SIL equals to how much? 2000 lakhs. Now what is requirement? Market value or just market value of equity? Market value of equity. Market value is different. Market value of equity is different. Now out of market value, if you reduce the market value for debt, there is a no new specification. That's why go with the previous one only. What is the previous one? 400 lakhs. You will get a market value of equity. Hope you guys you understand. Now how much, sir? 1600 lakhs. Now when it comes to the calculation, 1600 lakhs into 10%. 160 lakhs, sir? 160 lakhs. Can I put this 160 lakhs in real company? Can I put this 160 lakh in real company? Can I put this 160 lakh in real company? No. You have a capable for risk taking. Are you clear? So ఇన్ని రోజులు నువ్వు రిస్క్ కంపెనీలో కదా ఉన్నావు. ఇన్ని రోజులు నువ్వు ఆ డెట్ రిలేటెడ్ నీ ఓనర్షిప్కి రిస్క్ని ప్రపోర్షనేట్ చేసుకుంటూ ఉన్నావు కదా అక్కడ. ఇప్పుడు అంతే రిస్క్ నువ్వు బయట అప్పు తెచ్చుకో, తప్పేం లేదు. ఇన్ని రోజులు బేర్ చేసినప్పుడు ఇంకా బేర్ చేయలేవా? దట్స్ ద అసంప్షన్. Guys, clear? Now this is not a amount ready to investment. It is a just amount I have if I sell my stake. Now as per assumption, can I take loan from the outside? It's a risk proportion. Add amount of debt related to risk capabilities. Now amount equals to, so how much ownership I have? 10%, right? So if I have a 10% means I am facing a risk to 10% only. So what is the debt value? 400 lakhs. I faced a risk, my ownership 10%. I can take loan of 40 lakhs from outside. Guys, clear? Now you have to write the word total amount equals to equity share plus risk. Equity share plus risk. Now if I sell my stake, I will receive equity share 160 lakhs. I can capable for risk bearing. That's why I'm taking a loan from outside 40 lakhs. Now what is the total amount in your hand? 200 lakh for investment. Guys, clear? Done? So step 2 completed. Step 3, percentage of stake in RIL. Investment divided by market value of firm, market value of RIL or market value of equity. Can I use both alternatively? Why? Because it is unlevered firm. Guys, clear? But when it come to here, if you use that logic here, it is a wrong answer. Here firm value means equity plus debt. When it come to here, just equity. That's why firm or equity both are same. Now what is the amount in your hand to invest? 200 lakhs. What is the market value of equity or market value of firm RIL? 1000 specified in the assumption, new point, 1000 into 100, you will get a percentage, 20%. Now I am capable to ask 20% return from the real. Yes or no, sir? If I invested 200 lakhs, how much percentage I receive as a ownership? 20%. That's why I have a right on equity earnings 20%. Now, return on real. So that is equals to equity earnings into stake. Equity earnings into stake. So how much is the equity earnings? 100 lakhs, sir. Any interest adjustment? No, sir. Why? Because there is a no debt, sir. Now, entire 100 lakhs EBIT is known as equity earnings. Into stake 20%. I can enjoy 20 lakhs. But I can't enjoy total 20 lakhs. Why? Here I borrowed 40 lakhs from the outsider. I have to pay interest. Are you clear now? Now done. Less interest to borrow to outsider. So I received 40 lakhs from him at the rate of 5%. Therefore, 20 divided by 400 into 100, you will get a 5% of interest rate. It also not specified. You have to figure out. Guys, clear? Percentage rate is not given. How I find out? It means already company paying 20 lakhs interest for 400 lakhs of debt. How much percentage they paying? 5%. Guys, clear? Now, out of 40 lakhs, 5% means how much? How much? 2 lakhs. Now I can enjoy 18 lakhs benefit if I shifted to new company. But they are not asking about the new company earnings. They are asking about the between the earnings, arbitrage profit. So next step, arbitrage profit. Return on real minus return on SIL. Now what is the return on real? 20 lakhs or 18 lakhs? 18 lakhs, very, very important. Now what about the return on SIL? 8 lakhs. Now how much benefit you will receive extra? 10 lakhs. This is called arbitrage gain or arbitrage profit. If you not follow the assumption, you will not receive that much. Are you clear? Done. This is a presentation. It's like a process. First, I am calculating my existing company earnings. Then I am selling my stake. I will receive some X amount. I will put that on X amount on a new company. I will get a percentage of stake on that company. If I get a percentage of stake, I will get that much of earnings. That earnings and existing earnings comparison is known as arbitrage gain. The process of calculating, you have to follow two assumptions based on the shifting. If unlevered to levered, one type of assumption, levered to unlevered, another type of assumption. Are you clear, sir? Only one problem is there, sir. They can frame a new problem based on this concept. Are you clear? Now, that's it, guys. So up to here, cost of capital completed, capital structure completed. Okay. Now, valuation of share based on P multiple and Gordon's model. So valuation of share based on PE multiple and Gordon's model. I shared a PDF in a group, sir. Okay. So next class you can take the books, print is completed. You can go and ask the management, they will give. Okay. So valuation of share based on PE multiple and Gordon's model. So, okay, done. So understand this sentence once again. Valuation of share. It's a singular or plural? Singular. Can I use the word per share? Here I am find outing not total number of shares. Here I am find outing per share. That's the point you have to understand. Previously I calculated market value of equities about a total shares. Now onwards I am calculating V0 or P0. V0 or P0. V0 means value per share. P0 means price per share. Both give same answers. Guys, clear? Now calculation of value per share based on PE multiple and Gordon's model. The word multiple is not a new thing. It's a similar word. Previously you learned in your intermediate PE ratio. Instead of ratio they used a name called multiples. Guys, clear? First we focus on the PE multiple. When it comes to PE multiple, we have a lot of subclassification of PE multiples: forward, backward, forward PE, trailing PE. This all we will discuss under chapter 6, valuation of methods and approaches. Here just we follow the basic rules. So as per PE multiple, we know that PE ratio equals to MPS divided by EPS. Market price per share divided by earning price per share. Are you clear? You can also write like this: market value of equity divided by EAESH. Market value of equity divided by EAESH. Market value of equity divided by EAESH. So what is the difference between MPS divided by EPS and market value of equity divided by EAESH? So both give same answer, sir. MPS divided by EPS talks about per share point of view. Market value of equity divided by EAESH talks about total point of view. Guys, clear? Done. Now, so when it comes to the conceptual clarity about the PE ratio, we can learn on two perspectives. One is company point of view, another one is investor point of view. So a lot of people saying that I'm an investor, I'm investing so many companies, I'm investing so many companies. They don't know about the analysis, how to do, what to do. But they don't know some technical source. And the technical source, everyone checking the ratio name called PE ratio as an investor point of view. So he feels that if it's a low PE ratio, it's a good to buy. If it is a high PE ratio, it's a not good to buy. That's the only thing you know. Why he don't know. If it's a low PE ratio, so best to invest. If it is in a high PE ratio, don't invest. So how I know, sir, it's a low or high? If I compare with the two companies. Yes or no, sir? How can I say it is high or low? Means I have to compare with the two companies. For example, so I have a MR of company PE ratio. It always shows times. It always shows times. So what is the MR of company PE ratio? 40 times is the answer. Same CET company is there, tire manufacturer. So that company's CET PE ratio is 28 times. Now if you give these two values to as an local investor, he will say purchase CET tires instead of MRF. Guys, clear? So let us discuss why. Why means the meaning of 40 times. Every 1 rupee of company earnings creates a 40 times of market value. Every 1 rupee of earning creates how much? 40 times of market value. Company point of view. When it comes to investor point of view, if every 1 rupee of company earns, I need to pay 40 times more the earnings. Hope you guys understand. Company point of view is a good. What is the company point of view? If you earn 1 rupee, it creates 40 times of my market value. When it comes to investor point of view, if that company earns 1 rupee, I need to pay 40 times extra. Yes or no, sir? Same logic come to CET. First, company thinking. If my company earns 1 rupee of earnings, my market value creates 28 times. Yes or no, sir? Comparing to company point of view, this one is bad, this one is good. Why? Because CET not creating that much of market value, company standpoint of view. But when it comes to the investor point of view, how he thinks, if CET company earns 1 rupee, I pay only 28 times extra for purchasing that share. Now investor, here for 1 rupee he need to pay 28 times. Here 1 rupee he need to pay 40 times. Which one is the best investor point of view? See it. Yes or no, sir? That's why all local investors choosing low PE ratio. Low PE ratio. This is a conceptual clarity about the PE ratio. Company point of view as well as investor point of view. Company point of view, which one is a good one? MRF. For 1 rupee company creates earnings, the value created by 40 times. Yes or no, sir? But investor point of view, oppositely we need to think. Okay, done. So apart from the subject knowledge, so maximum of the cases, if they give PE ratio, means it is a clue for MPS calculation. It's a clue for what, sir? MPS calculation. Now MPS equals to, shuffle the formula, PE ratio into what, sir? EPS. Just shuffling the formula. Just shuffling the formula, you will get MPS. So MPS equals to PE ratio into EPS. When it comes to alternative, so here you will not get market value per share. Here you will get market value of equity. How? PE ratio into EA/ESH. PE ratio into EA/ESH. దాని గురించే మర్చిపోయా, ఇక్కడ అడ్జస్ట్ చేస్తున్నాను నేను అప్పటి నుంచి. ఓకే ఓకే guys, clear? So total point of view we can say, as well as per unit point of view we can say. Sir, can I convert this total into MPS? Can I convert this total into MPS? Divided by number of shares. Divided by number of shares. What you will get? MPS. If you know the one thing, you can easily find out anything. Guys, clear? MPS equals to market value of equity divided by number of shares. Market value of equity divided by number of shares. So this is about the PE ratio point of view. Okay, now let us learn new things. Gordon's point of view. So when it comes to the Gordon's point of view, he expresses based on dividend only. So here we are calculating P naught based on dividends. Based on dividends. Gordon's dividend model is a full name. Gordon's dividend model. Gordon's dividend model. So as per Gordon's, we have a two types of dividends. Forecasting dividend perpetual dividend. Forecasting dividend perpetual dividend. So anyone tell me about what is the mean for forecasting, what is the mean for perpetual? Sir? No sir, after involving the perpetual forecasting, you have to discuss about the growth or not growth. Before that, we have to understand the meaning of perpetual and forecasting. In two cases, we have a growth and with growth and without growth. But first understand what is the forecasting and perpetual. I think forecasting is a new word. Perpetual we know. If investor receive in an indefinite period of dividend, it's called perpetual dividend. infinite life. What about the forecasting? Opposite to that. What is the opposite? Investor receive only certain period, either 5 years or 6 years or 10 years or only one time. This, if you know the year, that is called forecasting dividend. Guys, clear? So based on this forecasting dividend, based on this perpetual dividend, you have to calculate. Are you okay? Sometimes in problems they will give both. One problem is there. Sometimes they will ask only forecasting point of view. Sometimes they're asking only perpetual point of view. Sometimes they will ask both forecasting plus perpetual information they will give. You have to figure out V naught or P naught. Guys, clear? Done. Now see, forecasting period means noun period. For example, 5 years or 10 years or 20 years, like that. You have a 10 years information or 5 years information or 20 years information. How you calculate? As per forecasting period Gordon's model. Are you okay now? When it comes to perpetual dividend means infinite life. Infinite life. That is nothing but infinity. We don't know the n number of years. We don't know the n number of years. Okay now? Done. When it comes to forecasting dividend, without growth, with growth, without growth and with growth. When it comes to here, perpetual period calculation also we have same concept name called without growth and with growth. Take an example to understand. DPS equals to EPS equals to 12 rupees. Payout ratio equals to 50%. N equals to 5 years. N equals to 5 years. Please calculate V naught. V naught represent value per share. If there is a no growth rate means we can't take any assumption. Just follow it is a without growth concept. So here it is a forecasting or perpetual. Forecasting or perpetual. Why? Because every year, how many years? 5 years. You will receive every year dividend for how many years? 5 years. Guys, clear? Now see, years, dividend, year 1, 2, 3, 4, 5. Now they given EPS information, but you saying that it is a dividend model. You saying that it is a dividend model, but given information is a EPS. Can I take it as a EPS is nothing but DPS? No sir, here payout ratio is given. It means if company earns 12 rupees per share, they can't share entire 12 rupees, they will share only 50%. It means 6 rupees. Dividend. First year 6 rupees. What about the second year? Why? Without growth, exactly. 6 rupees. Third year, 6 rupees. Fourth year, 6. Fifth year also, 6. Now here they not give any indefinite period information. They provided only for n number of years information. Guys, clear? Now can I total this? 5, 6, 30, yes or no sir? 5, 6, 30. 30. Okay. So if when it comes to the valuation, it is not a right way. It is not a right way. Why? Because what is the full form for V naught? Yes, exactly. The word is very, very important. The naught represent current value per share or present value per share. Current value per share or present value per share. Guys, clear? Understand? Okay. Now the point is, when you calculating V naught, This amount receiving at where? Beginning of the year or end of the year? 6 rupees. End of the year. You are at day 1. That amount receiving. This is end of the 365th day. 1 year time travel is there, na? The two values are not same. You have to convert that 6 rupees to present value, discounting. Guys, okay? If you take directly 6, it is a wrong answer. So this 6 rupees, when you will receive? End of the second year. You are at the first day. You need to convert that 6 rupees to 2 years present. 3 years present. 4 years present. 5 years present. Simple. Are you clear now? Done. So present value factor at the rate of 10%. Assumption. Just understand the example. Sufficient. Not don't write. Are you okay? Now how to calculate present value factor? Take 1 divided by 1 plus I equals to n times. Now what's the first year? 9090. Second year? 0.8264. Third year? 7510. Fourth year? 6830. Fifth year? 6209. Now if you multiply with this dividend and present value, you will get a present value of a dividend. Very clear? Now please calculate and go with the M plus MRC trick. Tell me the direct answer. 22.74. This is your V0. 22.74 is your V0. So sum of present value of a dividend is known as value per share under where? Without growth concept. Without growth concept. Guys, clear? Next. Example number 2. EPS 12 rupees. Dividend payout ratio or payout ratio. You go with the full forms. 50%. N equals to 3 years. G equals to 12%. Now please find out V0. Which model it is? No, Gordon's forecasted with growth model. That much of clarity you have to maintain. Guys, clear? Now same, because of more than 1 year information, we are framing the table. Years, dividend, present value factor at the rate of 10%. Cost of capital equals to 12%. So you will get a present value of a dividend. Now what about the year 1 dividend? 6 rupees. Huh? Now what is the present value factor? 0.9090. Now what is the present value for dividend? What, sir? 5.54. Are you thinking that 5.454? Do you think it is the right answer? Do you think it is the right answer? Why, sir? So unless they specify, if they talks about just EPS and payout ratio, it is about current. It is about current. What I required next year. What I required, sir? Next year. The 6 is known as D0, but I want here D1. What I want, sir? D1. This is the logic they followed for all problems in your entire valuation chapters. Just learn here itself. Very clear, sir? If they not talk about any cash flow or dividend or earning about the next year or estimated, you have to take an assumption it is a current year. If they give a growth rate, first year itself you have to take the growth value. First year itself you have to take the growth value. Why? Because 365 days completed, na? So if 365 days completed, you will expect what? Current DPS or next year DPS? Next year DPS. Guys, clear? Now this is the right way, wrong way. Now what is the right way? Year 1 equals to D1. How we get a D1? D naught into 1 plus growth. Now what is the D naught? 6. 1 plus growth 0.12. Now what is the dividend value? 6.72. Now 0.9090, you will get a present value of a dividend. 6.108. This is the right one. Guys, clear? Now when it comes to second year, guys, when it comes to second year, can I take 6.72 or 6? 6.72. 6.72 plus 12% for second year growth. Okay. You said D naught, initial value. Okay. Sir, we have a two alternatives, sir, here. You can D naught equals to D naught into 1 plus growth square or D1 into 1 plus growth directly. You can do same, you will get the same values. For initial stage, that's why I'm writing individually, clearly. Next time I can say direct, I will do direct answers. Now, so when it comes to 6.72 into 1 plus 0.12, answer 7.5253. Now what's the present value factor? 0.8264. Now what is the present value for dividend? 6.22. When it comes to third year, D3 you have to consider. Now you have a two logics, D0 into 1 plus growth cube or D2 already 2 times grown plus third year growth. 7.53 into 1.12. 8.43. What's the present value factor for third year? Third. 0.7510. 0.7513. 6.33. Now please sum all present values. 6.108 plus 6.22 plus 6.33. 18.66. This is your V0 or P0. Guys, clear? So maximum example 2 they will ask. Any doubts? Sure. So shall I start with the infinity life? With growth or without growth? You already know what is the formula for dividend model without growth KE calculation. KE calculation under dividend model without growth. KE equals to D1 divided by P0. Yes or no, sir? Just shuffle this. V0 or P0 equals to D1 divided by KE. Completed. I already said now at the time of explanation. Here we already valued. Now when it comes to with growth, dividend model with growth, KE calculation. KE equals to D1 divided by P0 plus G. If you shuffle this, you will get a P0. That is under with growth Gordon's model also. Now, I want V0 or P0. That equivalent to T1 divided by KE minus G. If it completed, we can start the problems. So all clear about PE point of view as well as this Gordon's model point of view. If you have any doubts, ask me now. Sir, you can student have a lot of doubts here. Sir, here you are not in, it is a infinity life. You are not multiply with the present value factor. Here you multiplied with the present value factor. Why? Because they are future values. Infinite life value also what value? Future value only, na? Yes or no, sir? But the V0, P0 itself saying that it is a current place. What is the full form for V0? Present value. That's why this calculation answer also showing that what? Present value. You need not to bring from future. Guys, clear? Done. Now open illustration number 7. It's a basic version of problem. So Lalita Sri, hi. Thank you. Thank you for your valuable comment. So let's assume that shareholders of Miss Alka hold the shares of A Limited for a what period, sir? Infinite period. Okay, done. A Limited is matured company giving a constant dividend. What does it mean for constant dividend, guys? There is a no growth aspect. 10 years back 6 rupees. Today also, this year also 6 rupees. Next year also 6 rupees. But here 3 rupees. Now Miss Alka expects 12% return from her investor. Can I take it as a KE? Here onwards, I am changing the names of all. Here onwards, I am using a word called required return. Required return. You can use the word KE is a good, no issue. But the professional word is R, required return. Why? Because same concept reflected in discounted cash flow method. That discounted cash flow method, we are not using dividends, we are using cash flows. For cash flow purpose, I can't use the word KEKO, I use the word called R. For uniformity purpose, I am using here also R, required return. If it's a company point of view, KO is the required return. If it is only equity company point of view, KE is the required return. Guys, clear? Done. The value of A Limited of Miss Alka would give by the present value of dividend received. Present value of dividend received forever. So here V naught equals to D1 divided by P naught. Yes or no, sir? Sorry. V naught equals to D1 divided by R. There is only the formula. This V naught shows what, sir? Present value of dividend received. You need not to bring from the future. Okay. Where is the future year? Which year I need to consider as a future? Infinity means which one? There is no number of years, right? Yes or no, sir? That's why we are using direct logic instead of multiplying. Are you okay? In combo is there now, forecasted as well as perpetual. That combo we are using future value calculation also. I will give a clarity. Now, so direct answer 3 divided by 0.12. Answer 20 V naught. When it come to some more extent, for same example, Miss Alka hopes that A Limited will give a dividend of rupees 3 per share. What year? Can I use it as a called directly D1? So there is a clue words. Next year, expected, estimated, pace. If they give that words, it is directly D1. If not give that word, or if they give a current word, it is called D0. We are not using D0 for the calculation. You need to convert the D0 into D1. Are you clear? Now here also V0 equals to directly D1 divided by R minus G. What is the D1? 3 divided by R 0.12 minus G 0.06. 3 divided by 0.06. 50 rupees. Guys, clear? MCQ based questions. Come to illustration number 9. Some exam. It's a workbook question, guys. Newly added. So read the question carefully. Akash, it's a just example, Akash. I returned it's a 12%, but I taken 10%. Sorry, it's a just 10%. Sir, rectify the example, sir. One student had a doubt. So we graded cost of capital 12%, but here we consider for easy purpose above values. Okay, done. So what do you understand, guys? Estimate the value at the end of the 10 years using Gordon's growth model, PE multiple. Okay. Now the point is the using a word called terminal value. So the word value means we can take 2 points, either per unit point of view or total point of view. Are you clear? There is no clarity in this terminal value word. If you understand the entire concept, they provided per value shares, per share point of view. That's why here value means what? Per share. Are you clear? Now, according to Gordon's model, D1 divided by R minus G. Are you agree? Now, when it comes to PE multiple, PE ratio into EPS, that equals to MPS. That is nothing but V0. Completed. Okay. Do the presentation. Do the presentation. What's the problem number? Problem number 9. Write down the first given information. So the intro class only I said, in valuation, first go and check the requirement. If you understand the requirement, then please procure the values from the information. Are you clear? Before that procurement and requirement, you have to write down the formula. You can get easy answers. Now, given information, please. EPS is given a first sentence. What are the values they given? Write it down properly. Now, earning per share. How much? 12 rupees. What about the next? Payout ratio is given. How much? 50%. Good. Required return. Required return. How much percentage? 11%. Next. Growth for perpetual life. Yeah, growth equals to 4%. That's it. Now, case 1. Estimation of terminal value. Oh, PE ratio also there. PE ratio, please. 8 times. Estimation of terminal value under Gordon's growth model. Now you can write direct formula. V0 or P0. Go with any one word. That is sufficient. V0 equals to expected dividend divided by required rate minus growth. Are you clear? Now note, first to find out the DPS. EPS into payout ratio. Now what's the EPS? 12. Payout ratio 50%. 6 rupees is the DPS. Now my question is, what is the numerator value? 6 or grown 6? So just 6 or growth 6? That's a point. Just 6 or grown 6? Why? Because growth rate given in the question. With growth or without growth model it is. If it is a with growth, if they says growth means it is a with growth model. If there is a growth rate, you have to consider that. given dividend is a current year or expected year is important. Now the word I said, there is a no clarity, you have to consider it is a current year. You have to grow up with what percentage? 6%. Sorry, what percentage? 4%. Now 6 rupees into 1 plus 0.04 04 divided by what is the required return? 0.11. What is the growth? 0.04. So if you read the question, they provided 10 years, I think. Yes or no, sir? 10 years they provided constant growth. After 10th year onwards, it will grown by 4%. It means this 6 is a after 10th year or before 10th year? Before 10th year. That's why you have to grow up with a 4%. Are you clear now? Very, very important, sir, growth value. So in cash flows also there. Same logics. If you learn properly here, we can play with the discounted cash flow methods. Problems. Now what is the answer? 89. So what about the next case? Case 2. Estimation of terminal value under P multiple method model. Now what's the formula as per P multiple model? MPS or V naught equals to P ratio or P multiple into EPS. P ratio into EPS. So what's the P ratio given in the question? 8 times. What about the EPS given in the question? 12. Sir, 12 don't have a growth. 12 don't have a growth. That's the point. 12 don't have a growth. Under PE multiple, I am not discussed about the growth concept. In dividend Gordon's model only, I discussed about a growth concept. Guys, clear? Don't confuse. Now, what is the answer? 8 into 12 rupees 96. This is a way to find out V naught. This also be MCQ. Sir, in if you want a good marks in SPMBV, follow the presentation. Easiest paper. Why? Because they will expect presentation max. Okay, give the best presentation. So few problems is there in our material. The answers are just 3-4 lines as per suggested answer. Not in new syllabus, in old syllabus. And old syllabus they will give full answers. That answers also only 3 to 4 lines. We can't expect 7 marks from that 3 to 4 lines. Are you clear, sir? Next, read the question. Illustration number 10. Illustration number 10. Sir, write on the note point 1 here. I will explain at the time of company comparable multiple concept. Tailing PE ratio is there, na? I think they would not directly given PE ratio. They given tailing. Tailing PE ratio. Tailing is also be known as forward PE ratio. It consider past 12 months information. That is nothing but EPS. So tailing or forward PE ratio means it consider past information. So that also one of the reason we are not using a growth concept. Growth talks about past or future. Growth talks about past or future. Future. But tailing PE talks about past. Guys, clear? Next, read the question number 10. Exam standpoint of view question. Put a star. It also be a workbook question. Not there in your material. So after completion of this chapter 5, I start chapter 1, SPM. Okay. So after completion of SPM, for just a reference purpose, YouTube. Okay. After completion of chapter 1, we start with the BV only. Okay. Now illustration number 10. Smart Limited is deciding whether to pay out 400 lakhs in excess cash in the form of extra dividend or go in for a share repurchase. So simple terms, they're saying company have 4 lakh rupees of cash after settlement to all the persons as per income statement. First you have to settle variable cost, then you have to settle operating fixed cost, then you have to settle interest, debenture holder, then you have to settle tax, then you have to settle preference dividend, then you have to share. At the time of sharing, company taking a dividend decision. 100% is the best, 100% payout or 50% payout or 30% payout, that kind of decisions taken. Okay, done. Anyway, after settlement to all the people, company have in excess of cash rupees how much? 4 lakhs. For that 4 lakhs, they're doing 2 decisions. Based on the decision, our share price, how impacted is learning point. Now the first option is pay as a dividend to shareholders. Second point, we are not pay, we are repurchase. Can I use the word buyback? Buyback of shares. In these 2 scenarios, you have to figure out the MPS. Where you will get a best high MPS, that is the best plan. Very clear? Now, current earnings are 2 rupees and the stock sells for rupees 20. Can I use the word MPS? Okay. The market value balance sheet currently is as follows. Equity value, thousands, write it here, amount in lakhs. Amount in lakhs. So equity 1700 lakhs, debt 600 lakhs. The total liability is 2300 lakhs. Assets rather than cash 900, cash 400, total 2300. Now calculate the 2 alternatives. What are the 2 alternatives? Dividend payment of dividend, option 1. Repurchase of share, second option. 2 alternatives. The term of effect, the price per share. I said now. As per repurchase, what is the MPS? As per payment of dividend, what is your MPS? The EPS and the price per share of the stock, the EPS and the PE ratio. Which alternative is a better decision for the company and why? So if I know the 2 market prices, I can say the decision. Now use your knowledge and calculate the MPS as per option 1 without seeing the solution. Do you understand what is the option 1? If you pay 4 lakhs dividend, please calculate MPS by using given information. Write down the given information properly. So you are not watched YouTube classes, sir. So only day 1. It's a day 1. So at least try to watch last 3 classes. Just last 3 classes. So when you students Akash, please solve and tell me the answer. And Lalita Sri also. How much, sir? As per scenario 1. As per scenario 1, what is the answer? Sir, if you pay dividend, your company earnings are affected. If your company earnings are affected, yes or no, sir? Or your company PE ratio is affected? If you pay your dividend, or your company earnings are affected or not? Can I use the word EPS is constant? Your company PE ratio will change. PE ratio change when? If MPS or MPS or EPS is affected, PE ratio also be changed. But here earnings are not affected, EPS, MPS also not affected. Automatically PE ratio also not affected. It means there is a no change in MPS. So as per scenario 1, MPS equals to 20 rupees itself. 20 rupees itself is a clear concept. Very clear? So MPS equals to EPS into PE ratio, right? Now, how to calculate PE ratio? MPS divided by EPS. MPS given in the question, current market price 20. EPS given in the question, EPS 2. Now what about the MPS? 10 times. Now when it come to what is the EPS? 2 rupees. PE ratio 10 times. What is the answer? 20. Are you calculating D1 divided by KE? No, na. So here possible information only based on PE. based on PE. So why it is not affected means because of dividend decision not impact my EPS and PE ratio. If EPS PE ratio not impacted, my MPS also not impact. Previously how much I have, now also I have that only. Previously how much I have? 20 rupees. Now guys, clear? Huh? Now think in scenario 2 point of view. We will do presentation. Just think in scenario 2 point of view. Buyback. Buyback. How much you are paying? How much amount you are buyback? 4 lakhs. One share how much? How many shares you are buybacking? 20,000. If you buy back 20,000, how many shares you have? So if you want that, please calculate number of shares in your company. 85. Yeah, generally we are calculating number of shares based on face value. There is no information related to face value. If there is no information related to market price, I can take an assumption face value equal to 10 or 100 rupees. But there is a clarity about the market price. Are you clear? So that's why instead of face value, I'm using market price. Now please calculate total number of shares. 1700 lakhs divided by 20 rupees. How many zeros? 1700 lakhs or 17 lakhs? 1700 lakhs divided by 20, you will get 85,000. No. Here itself it's saying that 20,000. It means I think it's a 17 lakhs. Instead of lakhs, use the word 3 zeros. Okay. Now 17 lakhs divided by 20 rupees. How many shares? 85,000 shares. Now out of 85,000, how many you buy back? 20,000. Now company have how many shares? 65,000 shares. Now you have to figure out EPS for this 65,000 shares. Are you clear, sir? If shares are impacted, EPS impact or not impact? Impacted. Yes or no? Now, first find out the EPS. How you get EPS? ESH divided by number of shares. Now, how you get ESH? I think not given in the question. Per share 2 rupees. How many shares company have? No. That is the impact. Present. So 2 rupees EPS into 85,000. How much, sir? 1,70,000. This is your ESH. Sir, why I am not calculating for 65,000? Sir, ESH for all the shares, sir. Now you are buybacking. Yes or no? Now 1,70,000 divided by how many shares, sir? 65,000 shares. You will get new EPS. What's the new EPS? New EPS equals to 2.61. Now can I calculate PE ratio? I think PE ratio will change. EPS changes, PE ratio also changes. But as per textbook, the taken assumption PE ratio remains constant. You can see the first one for both the alternatives. In solution, first line. Are you clear, sir? What's the assumption they followed? PE ratio remains constant for two alternatives. Are you okay? If you are not following the assumption, how you calculate? PE ratio equal to MPS divided by 2.61. Are you okay now? If you are following assumption, don't calculate, directly take how many times? Previous 10 times. Now MPS equals to 2.61 into 10. 26.1 na? 26.1. Now scenario 1 market price is 20 rupees. Scenario 2 market price is 26.1 rupees. Market price, what you want? Minimum market price or maximum market price? Maximum. Which option you will choose? Option 1 or option 2? So if you buy back, your market value will be increased by 6.1 rupees. This is a way to say decision. It's a workbook question. The new workbook question. Are you clear, sir? Now the point you have to understand here, we are not calculating PE ratio. Here we are taking a assumption. Guys, clear? So if it's not taking any assumption, what the way to calculate? 20 divided by 2.61. Now what is our new PE ratio? 7.66 into new EPS 2.61. You will get MPS. 7.66 into 2.61. 20 rupees. I can't take decision. That's why they take an assumption of what? PE ratio remains constant. Hope you guys understand. If you follow the as per conceptual knowledge, so I will calculate new PE ratio. Why? Because MPS is there, new EPS is there. By using these two, I get a new PE ratio. But they take an assumption instead of new PE ratio for the decision purpose. Hope you guys clear? Now put a heading. Illustration number what, sir? This kind of model only they asked in exam, sir. December 24. Problem number? Estimation of value per share for two alternatives under PE multiple. Here I am not using any growth model, cost of capital model. What model I am using for two alternatives? PE model. Are you clear? Now write down the given information. So what's the first given information? EPS, as per question. EPS equals to 2 rupees. What's the next given information? MPS equals to 20. Next. Oh, cash. Okay. These are the information we have for calculation purpose information. That is called decision purpose information. Okay. Now, by using this, can I find out PE ratio for existing? I am not solving any cases. Just based on information, I am calculating values, possible values. PE ratio that equivalent to MPS divided by EPS. 20 divided by 2, that equivalent to 10 times. Can I find out the number of shares? Number of shares equal to equity divided by market value per share. Don't confuse, it's not a formula. It's based on given information, I recorded the formula. So what is the general formula means? Amount of capital divided by face value is a formula. Very clear? So here created formula it is. Now what's the equity value? 17 lakhs divided by 20 rupees. You will get how many shares? 85,000 shares. Based on information, these are the calculation probabilities. Now we start with the problem. If pays 400 lakhs as a dividend, before that write down the assumption. What's the assumption? PE ratio remains constant for both alternatives. If pays 400 lakhs as a dividend, MPS equals to EPS into PE ratio. Now what is the EPS? 2 rupees, huh? PE ratio 10 times. The answer is 20 times. EPS equals to 4 lakh divided by 85,000 shares. Answer please. Dividend per share also you will get now. Why? Because they are paying dividend. 4.70. If you pay 4 lakh as a dividend per share, how much they equity share will receive? 4.7. Now why I calculated this means this 4.7 not impacted my MPS calculation. This 4.7 is not impacted my MPS calculation. Hope you guys you understand. Sir, if it is a dividend model, instead of this calculation, I follow this expected dividend divided by KE minus growth. This kind of calculation I will follow. But here it is a which approach we are following to calculate under PE multiple. There is a specification you have to tell to the examiner where which point of view you are calculating. Okay, done. So second scenario, please. If buyback, so if you buy back, lot of things will change. Are you clear? Now number of shares buyback. Amount of buyback is 4 lakhs. Per share is 20 rupees. I will get a buyback shares. How much, sir? 20,000 shares. Number of shares after buyback. What's the total number of shares? 85,000. I am buybacking 20,000 again. So how many shares in the hands of company? 65,000 shares. So we have to calculate for 65,000 shares MPS. Guys, clear? Done. For the purpose, I want EPS. Previously, there is a no EPS changes. That's why I consider given information. But due to this number of shares, my EPS will be impacted. That's why I have to figure out new EPS. EAESH divided by number of shares. So EAESH not directly given. That's why EPS into number of shares. Number of shares after buyback. Number of shares after buyback. Now what's the EPS? 2 rupees. Number of shares 85,000. Before buyback. That's why I am not wrote anything. Number of shares. Number of shares after buyback for this EPS calculation. I am calculating earnings. EASH talks about total. EPS talks about a new issue after buyback. Are you clear? Now divided by 65,000 shares. Now EASH please. 85,000 into 2 rupees. 1,70,000 company earnings. Divided by how many shares you are finding out in the EPS? 65. How? That is a point. How many shares you want Guys, clear? 65,000 shares. Now, what is the new EPS? New EPS 2.61 per share. So, why I consider 85,000 in numerator means I am talking about the company earnings. Company earnings divided by impacted shares. Now, MPS equals to PE ratio into what? EPS or new EPS? New EPS. Now, PE ratio, any changes? No. Why? Because of assumption. 10 times. What is the new EPS? 2.61. Now, what is the answer? 26.1. This all under case A. We have a case B. Accept alternative 2, that is buyback of shares because it will give higher market value, higher market price. That is nothing but 26.1 per share. Clear? So next, illustration number 11. This question asked in December 23 for 7 marks. It's a basic question. About 2 problems, sir, workbook problems. This problem number 11 is a question paper problem. You can blindly trust this material, sir. All sources are included. Even though you don't know something called e-bulletins, every month our institute will release. On that e-bulletins, they are asking MCQs called case study based questions. 10 marks. Okay. So read the question. The following information of HL Limited are given. Current dividend rupees 2.5 per share. D1 or D0 it is? D0. If there is a no current, then also you need to take it as a D0 if there is a growth rate. Are you okay now? Discount rate. Can I take R? Discount rate. Sometimes I'm using cost of capital. Sometimes we are using minimum rate. Sometimes we are using required rate. All are same. R. Growth rate G. Based on the above information of HL Limited, you are required to calculate a present value of stock of the HL Limited. Based on above information, calculate. So based on above information, I understand it is a dividend growth model. Gordon's dividend growth model. Are you agree? Now simple completed. V0 equals to D1 divided by P0. Sorry. D1 divided by R minus G. So 2.5 into 1 plus 0.02 divided by R minus G. 0.105 minus 0.0. 30 rupees. Case 1 completed. All people are happy. Why? Because case 1 completed. They will give at least half of the marks. But even they will not give 2 marks. The entire question they are in case 2. Read the question, understand properly. Assess stock of Ashal Limited whether it is overvalued if the stock price is 35. Return on equity is 9% and EPS is 2.25. Support your answer with the complete workings. It's a question with don't have any clarity. So then if you observe this question, 7 marks we can easily crack. Yes, as per option 1. When it come to option 2, it includes subject knowledge, not expresses. By using this, you have to calculate MPS. Are you clear? What are the information I given? Return on equity is given, EPS is given. By using this EPS concept, by using this return on equity concept, please calculate MPS. Compare with this 35. Now please tell me about the overvalued or undervalued. That is the intention of the question. So with the help of EPS means I can use a P ratio. Yes or no, sir? So EPS means what? P is only the possibility. EPS I have a clue, sir. By using that clue, how I find out the MPS? The only probability is P ratio point of view. Now MPS equals to P multiple into EPS, I will get MPS. That is a hidden clue we have. Are you okay now? That's why if you know the P ratio, EPS they directly given in the question 2.25. If you multiply with the P ratio and EPS, you will get an answer called MPS. Are you okay now? Now when it comes to return on equity, it is a clue for P ratio. It's a clue for P ratio. As well as in above information, I have a EPS growth model. EPS growth model. That's why I explained KE calculation under with growth of dividend as well as without growth, as well as EPS approach is there. Same logics. Instead of D1, we are using EPSs. Are you clear, sir? So it's a very critical to answer at the time of exam, sir. This kind of questions are bouncers. Are you okay now? Done. So how I decide overvalued or undervalued? So a lot of times we are confusing. What you calculating is called estimated. What you calculated is called estimated. What they given is called actual. Are you clear, sir? Now just to follow the blind rule. If I calculated, this will be 30 rupees. If I calculated, what is the answer? 30 rupees. The only thing is, I am capable for 30 rupees. I am capable for 30 rupees. How much in the market? Overvalued. I calculated, my answer is 38 rupees. What is the capability of myself? 38 rupees. What is the market value? Undervalued. Go on buy. Overvalued, don't good to buy. It's overvalued, don't buy. If it is undervalued, buy. Buy more number of shares. Guys, clear? Huh? That's the way you have to compare. So if you do multiple times this kind of calculation in SFM also, there is a cringe of light confusion about the which one is a comparable. Undervalued to overvalued or overvalued to undervalued for estimated to actual. Are you clear, sir? What you calculate is your capability. Based on capability, you compare with the actual. Are you okay now? Done. So what's the formula for return on equity? What's the formula for return on equity? EA ESH divided by equity. Return on equity formula is EA ESH divided by equity as per your FM. Are you okay now? Okay, done. Can I write like this? MPS divided by EPS divided by MPS. What's the formula I recorded for P, second alternative? Market value of equity divided by EA/ESH. Second alternative formula. MPS divided by EPS is the basic formula. What is the second alternative? Market value of EA. We wrongly recorded. Yeah, right only. Market value of equity divided by EA/ESH. Guys, clear? Now the point is, this is the actual formula we learned. EA/ESH divided by equity. For instance, we are changing it per share point of view. EPS EAS is nothing but EPS point of view. Equity is nothing but market value per share point of view. Are you agree for this? Now 1 divided by ROE. 1 divided by ROE. 1 divided by, what is ROE formula? EPS divided by MPS. Now what happened? 1 divided by ROE equals to MPS divided by EPS. MPS divided by EPS. Can I use a name called PE ratio? Can I use a name called PE ratio? Yes or no, sir? That's a clue we have. That's a clue we have. Clear? Now we can use the word 1 divided by ROE, or you can also use the word name called what? PE ratio. The formula will be same. What's the formula? MPS divided by EPS. MPS divided by EPS. Now please calculate PE ratio. 11.11 times. 11.11 times into EPS they given in the question directly. 2.25. Answer? 11.11 into 2.25. 24.20. 25. Okay. What is your capability? Capability is 25. You are capable for 25. You are ready to invest for 25. But how much in the market? Overvalued or undervalued? Overvalued. Are you clear, sir? This is a one way of calculation. Next, you can see this 25. Okay. Next, when it comes to the second value of stock under earning growth model. So what is the EPS we have? 2.25. 2.25. It is a E0. I want E1. So multiply with the growth. What's the growth rate? 2%. 1 plus 0.02. Now what is the expected earnings? 2.295. Nana clear? Now R minus G, you will get a value per share. Now the point is, this R don't take cost of capital. You have to take this return on equity. Why? Because case 2 is special case. Case 2 is a special case. It's not related to the above information. Now return on equity is nothing but cost of capital here. Now what is the R? 2.295. R minus G, 0.09 minus 0.02. Answer? Answer? 2.295 divided by 0.06. 32.78. What is your capability? 32.78. Yes or no, sir? But what is the actual price in the market? 35. Are you capable to buy or not capable to buy? Not capable, overvalued. Are you clear, sir? If it's overvalued, are you ready to buy or not ready to buy? Both cases, share price is overvalued. These concepts are not explained by a question. Are you clear? This is a hidden concepts they given. They're checking your capability, they're checking your knowledge, they're checking about the MPS point of view. Are you okay? So just without seeing the solution, write it down by using the case 1, case 2, case 3. Here we have a 3 cases. What's the case 1? MPS as per Gordon's growth model. What's the case 2? MPS as per P ratio point, P multiple point of view. Case 3. MPS as per earning growth model. Are you clear? Please solve. So do in your home, sir. It's a homework problem. Are you okay? Now come to illustration number 12. Come to illustration number 12. Sir, anyone have any doubt on that question number 11? No, no. So in case 2, we have a hidden calculation parts. One is PE point of view, as another one is earning point of view. Are you clear? Done. Now illustration number 12. Python Limited currently pays a dividend of rupees 2 per share. A valuer forecast growth of 15% for the next 3 years, followed by 4% growth in the perpetuity thereafter. The required return is 13%. Calculate the current value per share. I am not getting this question. Anyone, please help me. Python Limited currently pays a dividend of rupees 2. I understand it is a D0. A valuer forecast a growth of 15%. It is known as G. For the next 3 years. Can I use the word? It's called forecasted period. Next 3 is the forecasted period. Now followed by 4% growth. I think it is called short-term growth. It is called long-term growth. Yes or no, sir? For the first 3 years, they have only growth of what? From 3rd year onwards for lifelong, they will receive 4%. 2 growth is there. Forecasted period growth, terminal or perpetual value growth. Guys, clear? Okay. So based on that, I understand it is a which model? Perpetual plus terminal value, or forecasted plus perpetual value calculation. Clear? Done. The perpetual thereafter. The required return is 13%. Calculate the current value per share. Okay. So problem number 12. Calculation of value per share under Gordon's growth model. Years expected dividend. Do you want present value factor? Why? Because 3 years means year 1 ending, year 2 ending, year 3 ending. Present value factor at the rate of 13%. So you will get a present value of expected dividend. Now listen and tell me the values. Year 1, what is the expected dividend? Given value, or you have to add the growth? Add the growth. What's the given value? Current year. 2 into 1 plus growth rate. 2 growth rates is there. Which growth? 15% is a short-term growth. So 1.15. Now what is the expected dividend? 2.3. Now please tell me present value factor at the rate of 13%. 0.85. 885. Now present value of expected dividend. When it comes to second year, 2.3 into again 15% growth. 2.645. So what's the present value factor? What's it? Type C charger. Type C charger. Anyway, cool. So solve. How is it? 0.783. Now what is the present value of expected dividend? 2. 071. Third year, please. Previous year 2.645, grown by 15%. Answer. What, Nana? 041. Go with the 3 elements. What's the present value factor? 3 numbers after point. 6930. What's the present value of expected dividend? 2.107. Now come to the 4th year. First you have to find out the value, then value into multiply. So the basic sense here, up to 3 years we are calculating first year, second year, third year. Next 4th year onwards we are not calculating particular year, we are calculating perpetual life. Are you clear? At the time of calculating perpetual life, first we are finding out the value. Are you okay now? So these values are given directly, but perpetual value not given directly. You have to figure out. That's why we have a formula called D1 divided by R minus G. Guys, clear? Now, from 4th year to infinity, you have to do note. So D4 divided by R minus G. Are you agree? D4 or D0? D1. D4. Are you clear, sir? Now I don't have a D4. I can calculate the D4. How? D3 into 1 plus growth divided by R minus G. What is the D3? 3.041 into 1 plus growth. 1 plus 4%. 4%. Don't confuse. 15% only for short term. For first 3 years. For infinity life, 4%. Very, very important. Now 0.04 divided by R. 0.13, yeah? Minus growth. Here also again 0.04. Answer please. Rupees 35.1. Go with the 35. So this is the perpetually you will receive. Yes or no, sir? Now here you have to put that 35. Now what about the present value factor? That's a point. What about the present value factor? 4th year, infinity year. 4th year, infinity year. 4th year, infinity year. Sir, we are doing a calculation at 4th year beginning, 3rd year ending. We can't calculate. So it means 3rd year ending value is nothing but a 4th year beginning value. Guys, hope you understand clearly. Very, very important point. It will be reflected in every calculation. So here you have to calculate perpetual value. But I don't want perpetual value. I want what? Present value. If you want a present value, you have to bring that perpetual year to 0 period. Perpetual year means there is no n number of years. Yes or no? No? That's why where we calculated 4th year, what? Beginning. 4th year start to infinity. 4th year start to infinity. That's the point you have to understand. Here 4 means not ending. 4th year beginning to infinity. So which year ending it is? 3rd year ending. That's why consider 3rd year present value factor. That is nothing but again 0.6930. 20.35. Now what is the total? 30.56. Guys, clear? So lot of students are confusing on that present value factor. So are you okay? Okay, sir. Tomorrow we will continue remaining. Not tomorrow. Today there is second class. Okay. Anyway, thank you.